Hey there, 𝗧𝗏𝗏 with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to talk about what Huey Lewis can teach 23andMe about its takeout saga. And let's start with Huey Lewis's famous song, Working for a Livin'. I'm taking what they're given because I'm working for a living. When you're a business in extreme survivability mode and don't have a lot of options, you have to take what offer is presented. And this leads to the second maxim of Wall Street, which is if you can't sell when you want to, you sell when you can. And that leads us to this 23andMe ongoing takeout saga. And the rumor is that the founder had presented a takeout offer several weeks ago, and it was rejected by the original board. Subsequently, 7 board members resigned, and they rejected the deal for 2 reasons. The first is they felt that the financing wasn't appropriate, or the correct financing wasn't in place to get the deal done. And number 2, they felt that there was no takeout premium, which meant they couldn't accept the offer. Now, that begs the question, does it make sense that they rejected the offer? My answer is no. They should have taken this offer. Now, why did this go wrong? I think there's 3 reasons that are instructive to public company executives. And the first is voting control. When you look at the 3 primary people between the founder, GSK, and one of the other venture capital firms, you get to an aggregate of about 29% simple voting control. You really need to be in that 40% range if you want to get a deal done here easily, because you're trying to get to that simple majority, 50.1%, to say yes to the deal. Now, this leads to the second issue of selling the deal to the board. When you don't have that 40% plus voting control locked up to start, you really have to work the board hard, and you have to spend a lot of time with each board member independently, providing a case, providing the right detail, so that they feel saying yes is the right fiduciary responsibility. That probably didn't happen in this case, especially given the resignations. And then the third issue that no one is really focused on is the additional funding that the business likely requires. It's going to take a couple $100 million to take it private, but then you're going to have to add another $200 to $400 million to build a turnaround runway and a runway for profitability. And the problem is that you also need to have an operator that's going to be very laser-like disciplined in leaning the organization. I'm not sure if the board believed this, but at the same time, it's not the current board's problem once they sell the company to someone else. So what are the key learnings in this situation? And the first is, don't get cute about takeout premiums if you're in an extreme survivability case and don't have other options. And then finally, always remember your inner Huey Lewis in the news, working for a living, living and a working. I'm taking what they're given because I'm working for a living. When investor relations is too tough for you, it's just right for me. Let's get together. Thanks for watching.